Debt, lots of it. As the government borrows huge sums from multilateral leaders like the World Bank and the Asian Development Bank, many Filipinos are wondering, what will happen to us with inflated debt? And why does the government need to borrow this much money in the first place? Many are taking to social media expressing fear and anxiety, and understandably so. Filipinos have a complicated and painful history with government debt that stems all the way from the 70s. At the height of the Marcos dictatorship, government debt ballooned from $600 million in 1970 to $6 billion in 1980 in an attempt to build infrastructure. As a percentage of the country's gross domestic product, government debt rose from 10% of GDP to 20% of GDP in a span of only 10 years and with little to show for it. The Marcos administration borrowed so much so fast that the country plunged straight into a debt crisis in 1983. Succeeding administrations were left with shouldering the huge interest payments brought about by the Marcos loans. This explains why a lot of Filipinos have every right to feel uneasy with large government debt. But what really is government or public debt, and how should we look at it? In essence, the concept behind debt is the same for the two. Debt, also called loans or credit, is an agreement of one party to borrow funds from another and then repay the debt with interest in the future. The initial amount of money borrowed is called the principal. The cost of borrowing that principal is interest. One thing to note is that more often than not, the borrower goes through an intermediary, namely banks or capital markets, to access money provided by lenders. This is the role of financial institutions, to serve as a bridge between those who have money to lend and those who need it most. There are distinctions we can make between household and government debt in terms of why they borrow, whom they borrow from, and what constraints they have. Households incur debt in various forms like housing loans, auto loans, credit cards, and do so to fund activities for personal consumption or investment. We use credit cards to pay for restaurants, gas, and shopping. We take out loans when we're in the process of buying a new house or a new car. The government, on the other hand, borrows to raise funds, not for personal consumption or private investment, but for activities that benefit society at large, such as infrastructure projects and social services. These projects are a social good. They should benefit all and not just select parties. Another more important difference between government debt and that of households and companies is the available sources of funds, and this is also tied with their ability to pay. Households are able to borrow directly from institutions like banks, cooperatives, and pawn shops, or more informally from other households. They are limited to these sources, which assess them based on their credit scores. The ability of households to pay loans is largely determined by their salaries. This is why it's good for households to live within their means to avoid drowning in debt. The government, on the other hand, does not have this constraint. Theoretically, the government can borrow as much money as it wishes to because it has unique abilities to get sources to pay that debt. First is its power to tax the citizens. Second is its power to print money, which doesn't literally mean minting new bills on a printing machine. Rather, the government prints money when the central bank purchases securities issued by governments, banks, and other businesses to inject money into the economy. Third is through borrowing money from multilateral institutions such as the World Bank and the Asian Development Bank. These are institutions that assess countries based on their credit rating and intended project. Of course, just because the government does not have a theoretical ceiling for borrowing does not mean they should keep on taking out loans. The government has to be strategic about its debt. Let's see how this all works through the debt life cycle, starting with the household example. First, a household applies for a 20 million peso 10-year loan from a bank to fund the home that the members of the household can already start living in this year. Once approved, they get money from the loan to finance the home purchase. Over the 10-year term of the loan, the household earns income, a portion of which they set aside to pay the interest and eventually the principal. What about government debt? The government can borrow 2 billion pesos from the World Bank payable for a term of 15 years. The money the government gets is used to fund an infrastructure project, say a public bridge. Once the bridge is up, it creates a multiplier effect that benefits the economy. Over the 15 years, or the term of the loan, the multiplier effect is realized when people become more productive and more economic activity is generated as people use the bridge. The people who help make the bridge get jobs, and as people use the bridge, the faster it takes for them to get from one place to another and the more trips they can take. The government eventually is able to raise taxes or customs from this additional output. Those revenues will then be used to settle the debt that was borrowed. So is debt a bad thing? Not necessarily. But as in most things, there are nuances that should be understood. One important thing to note is that we shouldn't look at debt in absolute figures, but should contextualize. The Philippines has a total debt of 9.6 trillion pesos, or $190 billion. The size of the total debt in the US and Japan are 56 trillion and $10 trillion respectively. You can compare debt across countries, but what exactly does that mean? These absolute figures won't be able to tell a lot on their own. So what are the figures that we should be looking at? Similar to how we look at credit card bills relative to our monthly salary, or housing and auto loans relative to total savings, we should look at government debt relative to the total output or income of the economy, which is measured by gross domestic product or GDP. The debt to GDP ratio tells us how much debt exposure a country has. The Philippines has a debt to GDP ratio of 42%. That's fairly lower than levels our country has seen in the past, and it's also lower than the debt to GDP ratios of other countries. Another indicator worth looking at is interest payments as a percentage of revenues, or IP to revenues. The IP to revenues ratio of the Philippines has been on a downtrend in recent years, which means that our government is devoting less funds raised from taxes and customs to paying interest on debt and to more productive things like building infrastructure or rolling out social services. Finally, interest rates, or the cost of borrowing, also tells a story. The cost of the government for taking out a 5-year loan in the Philippines is 2.4%. That interest rate for the US government is 0.3%. So the Philippines' interest rate is 2.1% higher. That difference in interest rates is what you call a spread. The tighter the spread, the lower the borrowing cost for the government. Look at how the spread of the Philippine government's borrowing costs has evolved over time, and look at how it's lower than that of similar countries. This means that the country is still within a healthy range of borrowing. Again, government debt is not necessarily bad, and we shouldn't frown on our government from incurring new debt. Here are 3 things that we should remember. First, that government debt shouldn't get an apples-to-apples comparison with households. Second, that government debt can finance projects that are ultimately for the social good, such as infrastructure and services. And finally, that government debt shouldn't be viewed in absolute terms. Debt to GDP, IP to revenues, and interest rates are more useful indicators for government debt. What's the key takeaway here? We shouldn't worry so much about the Philippine government taking out a new loan, but rather where the proceeds of those loans go. Debt isn't bad. In many cases, public debt is even necessary to stave off economic crisis. During recessions, governments need to step up their spending in order to reduce the effects of economic collapse and rescue affected individuals and businesses. In fact, the opposite set of policies would only prolong the recession and delay recovery. These policies, broadly termed austerity, would have governments cut public spending so as not to incur debt. Austerity could leave people hungry and out of work at a time when government aid is essential. The way to jumpstart the economy is to pump more activity into it. Instead, what matters more is how our government uses the debt. And that's exactly where we need to demand greater accountability and transparency. The Department of Finance has announced 436 billion pesos of additional government borrowings for its coronavirus response. But 10 weeks into quarantine, it has only spent 48% of its planned budget for the original Bayanihan Act. And this is where we citizens come in, not in calling out our government for drawing new loans, but ensuring that the proceeds of these loans are spent properly.